The Federal Reserve has once again decided to hold off on any further rate cuts for the foreseeable future. This has brought up concerns that inflation won't be subsiding anytime soon, as prices aren't decreasing while jobless rates are gradually increasing. There are also whispers regarding potential bubbles in the stock market, which is consistently smashing all-time records. Let's delve into the effects of slower and fewer stock market price and rate cuts. What exactly occurred at the Federal Reserve, how this will affect you, and the potential implications across real estate, stocks, Bitcoin, and even your savings account earnings. To understand what's happening and the massive economic curveball that the Federal Reserve had to manage, we need to discuss inflation. In a nutshell, the Federal Reserve's primary goal is to bring the inflation rate back to their 2-cent target without triggering an economic downfall. You might have wondered why they specifically aim for 2% inflation. Well, essentially, it's a made-up number. In the early 1990s, New Zealand offhandedly mentioned a 1% inflation target, which was eventually rounded up to 2%, allowing a margin of error. The 2% policy was born without much economic data backing it up. This policy was adopted by the United States in 2012. Now on to the recent data, which is quite startling. Inflation can be measured in two ways: by tracking the price of everything or excluding volatile categories like food and energy. The inflation rate increased from 3.1% to 3.2% when tracking the cost of all items yearly. Meanwhile, core CPI came in higher than anticipated, with a month-to-month increase of 0.4%. This shows that instead of decreasing, inflation is, in many categories, only increasing, which has resulted in reduced rate cut expectations. Michael Burry previously warned that inflation appears in spikes, then settles, fooling people, only to resurface later. Regardless, the stock market has been doing incredibly well so far. This year alone, it has upped by nearly 10%, with many stocks achieving 52-week highs. Interestingly, this recent momentum is tied to AI. However, this is causing apprehension in some, who see it as a sign that the market might be in a bubble that could burst at any moment, resulting in a downfall of the entire market. Much of the current dominance of the S&P 500 is created by 7 stocks such as Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla, often referred to as the Magnificent Seven. Switching to Bitcoin, its prices have risen dramatically from $44,000 to $72,000 since January. When we examine Bitcoin from an unbiased standpoint, it remains both highly risky and extremely volatile. And speaking of uncertainty, let's discuss Jerome Powell's latest commentary in the context of the current housing market. The good news nationally is that inventory is gradually increasing. Now let's move to the rental market. Concerning Jerome Powell's comments, we expected a tough stance on inflation. Also, trouble is brewing in the banking sector. To navigate these turbulent times, it's essential to learn from past mistakes. A majority of Americans harbor financial regrets, most notably not maintaining an adequate emergency fund, not investing aggressively enough, and not purchasing property earlier in life. Furthermore, over half of Americans agree that good financial advice has assisted them in budgeting effectively. That advice typically falls into 3 universally recommended strategies. Firstly, the consensus stresses the importance of living within one's means. Secondly, the survey reveals that establishing and maintaining good credit is crucial. Finally, 75% advise that homeownership offers a practical way to accumulate wealth. As for the Federal Reserve meeting, we may see fewer and smaller rate cuts than anticipated. While the economy is strong, unemployment is low, and the stock market is performing well, they have no significant incentive to lower rates as rapidly as has been anticipated.